Ryan, there's a lot of new things that we're going to learn in retirement. Initials, there's RMD and IRS, and then there's another one called IRMAA. And that goes into what we look here because I know that as people go into retirement, how much is healthcare going to cost me? And you know that Part A of Medicare is free, but Part B is about $200 to $220 a month, but it can be a lot more. Explain how that happens, because if I say I think I'm going to have to pay 220 and then it goes up to $500, which it can, or even more. What happened there?
People go into retirement, they normally plan for retirement by thinking about everything in a fixed cost. My health insurance, no matter how much money I make when I'm working, for most people here, stays about the same. Yes, it begrudgingly goes up every single year because the cost of healthcare goes up. But you know, Medicare Part A, like you said, that's the free part. That's the part that everybody has to register for upon reaching age 65. Part B is optional depending if you're still working or, your health insurance coverage from having a pension, things of that nature. But, like you said, the cost is fairly low to start out with, but what nobody really thinks about or realizes until they get a fun letter from the Office of Medicare and Social Security is that the cost of your Medicare is income based, and it's called IRMAA, income related Medicare adjustment something. Because, but the basis behind it is that as a married filing joint couple, I think it's if you make under $180,000, it's a certain number. Once you go up, between 180 and 212, it's another number, but it gradually keeps going up and up and up until I think, it's around like 760 or $780 a month
Wow.
is what you can expect if you make too much money. So it's a good problem in my mind to have. I've worked hard, I've saved my money, I've planned properly. So now I can bring in all this money in retirement. I can live the lifestyle I want. But now the other side of that coin is now my Medicare is going to go up. And it is a conversation that we always have, and it becomes a really constant part of the conversation for us simply because we're pretty much talking with all of our clients, anybody who comes in to see us. We're talking about Roth conversions. We're talking about taking money out of your IRA, dropping it on your tax return and paying tax on it. Well, part of what that does is it pushes up your total AGI, your adjusted gross income. And if you cross the threshold, your Medicare goes up. So it's one of those things that we tell people is that, all right, here's how much of a Roth conversion we're going to do, but be aware you're going to get this bill from Medicare at some point in the next 2 years, because they often look 2 years behind, but sometimes they do go further, saying that your Medicare premium is going to go up. And people kind of not balk at it, but they almost want to argue, well, then maybe we shouldn't do this. And then what Catherine or myself or one of our other advisors here do is we'll show you we're going to raise your Medicare for the next 7 years because we're doing Roth conversions over the next 7 years or whatever the time frame is. Here is how much you're going to pay in Medicare over those 7 years before it drops down. Now, let's think about the real reason we're doing the Roth conversions that's causing this Medicare issue is to save you money in taxes over the long run. And you're 63 years old, 65, 66, 67. We're taking you all the way out to age 95. That's when I have to kill you off. I have to pick an end date. Statistically speaking, if you're, and this is a funny stat, if you are married at age 65, regardless of whether or not you are happily married, but just the fact that you're married, there's a 25% chance one of you makes it to age 94. And, I think if you're not happily married, you're going to do that out of spite because I'm going to outlive this SOB or something like that. But it's one of those things that will show you, here's how much you're going to pay in Medicare over the next 7 years because we're artificially increasing your income for these Roth conversions. And I say artificially because it's not actually money you're spending. It's just money we're putting on the return and paying tax on. Here's how much you're going to pay in Medicare, but here's how much money we're going to save you in taxes. And it is, I admit it is a balancing act because I don't want to increase your Medicare so much that now it's affecting how much money you have coming in to live on. And now, okay, you've taken an extra $500 away from me. I need to take $500 more out of my IRA on top of the Roth conversion. And it can kind of throw all that up, but That's really what tax planning truly is about, and it's such an important part of any retirement plan because like I said, not many people really think about the Medicare aspect. People always think about taxes in a manner of how can I reduce the amount of taxes I'm paying right now? Because whenever you get your taxes done, you're getting it done by H&R Block or a CPA or some tax firm. I guarantee you at some point in your life, you've asked them, okay, that's the number. But what can I do to make that refund higher? Or what can I do to make that balance I owe pay? What can I do right now? And unfortunately, the answer is there's not a lot you can do it in that moment. You really want to put those steps in place while you're working. You want to put those steps in place once you retire and while you're retired to help save you money in taxes. And it is a counterintuitive thought that tax planning, oftentimes means paying more taxes than you otherwise would in this exact moment. But you have to be forward looking your entire life, not your entire life, but when you get towards the later part of your working years, you're always looking forward to retirement, the date that I want to stop working. Well, let's take that one point further and think about the date at which I'm paying the least amount of taxes legally possible. And if you're in the right situation, that number can even be zero. The clients that I have gotten to zero, it's a really fun part of it. That's what makes actually doing tax preparation worth it for Catherine and myself is that when we sit down and we do the tax returns, I mean, every year I run tax projections for people to figure out where they'll be. And then I'll save that return. And then when I actually go to do their taxes, I don't often tell people this, but I go back and look at the projection to see how close I was to the number because it's just validation that the numbers are working for me. But then when we get them to that 0% number, it's just amazing. Years ago, she's since passed. I had a client, Bonnie, who came into my office. She worked for T. Rowe Price. She had money in a brokerage account with T. Rowe. She had a 401k with them. She had some individual stocks. And she was just kind of talking about retirement. And I said, okay, Bonnie, if we do proper tax planning, we start doing Roth conversions. By the time we hit age 67, because I think she was 56 or 55 at the time. If we start doing Roth conversions and planning on this now, by the time we hit age 67, you'll be paying $0 in taxes. And she didn't truly believe me. She said, yeah, okay, let's look at it. And I showed her the numbers. We put the plan in place. We did this for a number of years. And she retired and her spending number was about $112,000 a year. And every single year, her taxes at the end of the year, that number started going down and down and down and down until one year we did her taxes. And I was like, all right, Bonnie, I messed up this year. You were supposed to be at zero taxes paid throughout the year, zero taxes at the end of the year. You owe $12. And she just kind of looked at me and smiled and laughed. She said, I can't be mad because I made $112,000 a year and I'm paying $12 in total. No tax withholding, no nothing, $12. I mean, it's not for everybody. There are certain situations where, if you have a pension and Social Security, I can only get you so low. Catherine and I can only get you so low. But there are some situations like Bonnie where she didn't have a pension because that affects the taxable nature of your Social Security that we can get you down to that 0% tax bracket. But, no matter who you are, you owe it to yourself to pay the least amount of taxes possible. And it's not something that happens overnight. It does take time.
Catherine, as somebody comes into you and you meet them for the very first time and they think, okay, the market made 7% last year and I made 8, and they got their chest all puffed out and they're pretty happy about the whole thing. And you, being the person that you are, look at them and say 2 words: minus fees. And they don't even see that. And talk a little bit about the fees that are embedded within investments. Certainly there are fees for your advisor as well, but sometimes that 8% really isn't 8. It could be, 5. It could be much lower than that.
Yeah, I mean, one of the big things that comes to mind when talking about investment returns and high fees is people that, decade or so ago invested in variable annuities. They bought these variable annuities 10, 15 years ago. They put money into them and they're like, well, why aren't they earning any money? And we really sit down and we look at the cost structure of those said annuities. Yes, the market's done well, but you're paying, 1% in advisor fees, you're paying, another 0.6% in a rider fee, and then you're paying another 0.9% in a mortality and expense fee, which is basically a fee associated with variable annuities. And you're looking at the fee that comes off the top. And if you're averaging 6 or 7%, because that's usually what the market does over time, and you're paying, 3.5 to 4% fee, then you're netting 2 to 3% return.
Wow.
So those are some of the biggest fee shockers, I guess, we come across when we're meeting with prospects. And then a lot of times too is people don't know, if they're working with another advisory firm, not only is it your advisory fee, but it's the funds that you're invested in those fees as well. Here, Ryan and I was talking about mutual funds earlier. Another big problem with mutual funds outside of just the capital gains implications are the mutual fund fees. So people may say, oh, no, I only pay my advisor, 1%, but then they're paying another, 1.5 to 2% in mutual fund fees. So they're paying 3.5% on their portfolio total fees. So one of the things we do when you come in and bring your current investment statements to us is we do a fee analysis. We look at how much are your fees now, based off of a plan of how we would invest your money in the diversify in the different investments in the different tax buckets, what we think your overall fee would be if you were to work with us. And some of those conversations are hard to have because people don't realize how much they've paid in fees.
And Ryan, I think that some of the things that when we talk about fees, I mean, people don't even realize if within their 401k, there are fees. Within their IRA, there are fees. And people don't think, since I'm not talking to an advisor, that's through my work, there's no fees there. But actually, there are, aren't there?
Yeah, and that's kind of what Catherine's talking about is, most investment vehicles, unless you're buying individual stocks and bonds and doing it yourself, and I know a lot of the platforms have you get X amount of free trades, or you get X amount of free trades, or you have unlimited free trades on certain stocks. Unless you're buying and selling certain stocks, there are fees for pretty much every investment vehicle that's out there. Mutual funds, there's a fund manager who's in charge, who's running that fund. American Funds is a huge mutual fund corporation. They have to make a way to pay for all the employees that do all the administration, the bookkeeping, all that stuff, the mutual fund manager. So there's fees involved. Mutual fund fees average anywhere from 2.5 to 3%. And unfortunately, 99% of all 401ks all use mutual funds. And then there's an administrative cost for the 401k as well. And it's one of those things is that it's out of sight, out of mind. I don't see it. If you read that fund plan information or the prospectuses that you get sent once a year, you can find all the fees. So if you're looking at your 401k and you say, "Oh, I did really great. I did 8%." Well, in actuality, you did more than that. They just took away money in fees before you ever saw it. You can use ETFs. ETFs cost, anywhere from 0.01% to the really, really super, super cheap ones, or, there are some more active ones that are 0.7, 0.8%. But, fees are one of those things that you always want to be cognizant of. And there's nothing wrong with paying fees. There's nothing wrong with working with an advisor and paying fees for the investments, or, paying fees for the mutual funds and paying the advisor fee. I ethically, morally disagree with that. But, if you're happy with what's been going on, you're happy with the advisor that you're using, you're happy with the returns, there's absolutely nothing wrong with paying those fees as long as you are aware of what you're paying. And, kind of what Catherine alluded to is, when people come in and see us, is we ask them to bring in their investment statements. It's not because I want to see how much money you have. It's because I want to see what you're actually invested in so that I can show you, here's exactly the fees that you're paying. Because, if nothing else, you come in and see us, I'm going to tell you here's exactly what you're paying in fees. And I have no vested interest in telling you what your fees are. I'm just saying, here's what it is. If you want to work with us, here's what my fee would be. But you don't have to work with me just because you come in and see me. It really can just be for informational purposes, just to, figure out, what does a tax plan look like for me? Is my estate plan properly designed? Am I properly diversified? How much risk am I taking? But then lastly, like I said, how much money am I paying in fees? Because that's one of those things that really can eat into your returns year over year.
Financial advisors always like to talk about buckets of money. And if you think about it this way, you've got this bucket of money, your nest egg in retirement, and there's a leak in your bucket. There's a lot of leaks in your buckets. There's you, there's taxes, and there's fees that's leaking out of your bucket. Can we plug that hole? Maybe not completely. Can we make that hole a little smaller? Maybe so. Let's have that conversation with the team at Prostatis Financial. Give Mike and Ryan and Catherine and the team a call. 866-597-1040, 866-597-1040. If you've saved $500,000 or more for retirement, this is where the planning really starts to kick in, and you really start to see the benefits of this kind of planning. Find them online at thesavvyinvestorradio.com. There's a button there that says schedule a call. You can hit that, and you'll be on your way.